Hi, good morning, all. I hope you enjoyed the last session we did on economics of human capital. We all know the role of central banks becoming more discussed topics due to their strong measures post COVID to control inflation. Whether we talk about RBI India or US Fed, which has strong effects on the rest of the world, or we take it to ECB in Europe, where the geopolitical situation is currently tense, central banks always find to create a balance between the growth and inflation, which is never an easy task. We have with us someone who has not only worked on this aspect for years, but was also the brain behind many such reforms. We welcome Dr. Mridul Saggar, currently the IEPF Chairperson on Regulatory Economics at the NCAER, India's oldest and largest think tank on economic policies. He is also currently an IMF expert on monetary policy, providing consultancy to member IMF countries on short-term assignments. He was formerly executive director of the RBI and part of its six-member monetary policy committee that decides on policy interest rate and stance on monetary policy. He brings in 3 decades of experience in the functioning of central banks. I know you cannot wait to meet him. Dr. Mridul Saggar, we welcome you to this session of Indian Sun, and thank you for taking out time for us.
Thank you, Sachin. It's my pleasure joining you here.
So, before we start with your enriching experience, we would like to know about the evolution of central banks from you.
Okay, yeah, Sachin, actually, it's a good question to start with because that will sort of put things in perspective, especially if you want to ask me about monetary policy. So central banking has a little over 3.5 centuries of history. It started with the Swedish parliament setting up the Sveriges Riksbank, which is the central bank of Sweden in 1668. Sorry, not 1968. We tend to forget the old history. It was started with just 20 employees. The motivation of establishing the central bank was the collapse of a bank, actually, which was called the Stockholm's Banco. This was a commercial bank which first introduced banknotes in Europe. The issue of banknotes was prompted by the fact that Sweden was functioning on copper coins, which tended to weigh around 20 kilograms in weight. And they also had gold coins, but they were much less. And there was this issue of how intrinsic values of the two are, because gold coin was actually intrinsically more valued, but the copper coin was not that valued, but carried the similar face value. And that was also a challenge for the banks, the central banking, for some motivation of why you need to set a central bank. But the key reason why this bank was set up was because the Stockholm's Banco actually issued too many banknotes. I mean, they were like on an sort of an unlimited scale, and this caused a surge in lending, and we saw sort of a financial collapse coming up. So inherent in this story is that you needed an institution to establish both monetary and financial stability. And these are still relevant issues because from time to time, one faces financial crisis, hits some country or the other, essentially because central banks lose control, probably do excessive monetary expansion, give too much of liquidity, or they are not vigilant enough to sort of supervise the credit standards of a bank. So the central banking is still about the same sort of an issue. But I think there are other stories in this as well, because, Banco, the Stockholm's Banco had a lot of intervention by the monarchy of Sweden. and that sort of led to massive credit expansion. When the central bank was established, it came with sort of regulations that they were tasked to establish price stability. And inherent in it was that monarchy will have less interventions. And what it happened was that the monarchy still had a role. So it was not like an independent central bank we see in today's world. The central bank independence came much, much later. When this Swedish central bank was tasked to maintain the domestic coinage in a manner that it has a right and fair value, it actually had price stability as an objective. So then you see the Bank of England was started in 1694 with some 17 clerks and 2 gatekeepers. You look at the today's central banks, how different they are. And the Royal Charter, it was set up as a private bank, and the Royal Charter, which was granted by King William and Queen Mary, it explained that the objective was to promote public good and benefit of the people. Now, today also, the Bank of England's mission statement says that basically its objective is for promoting the good of the people of the United Kingdom, but they have added that by maintaining monetary and financial stability. So that's where the central banks have moved. The Reserve Bank of India actually had its legislation passed in 1934 and was set up in 1935. And it had 2 main objectives, like regulating the issue of banknotes and keeping the reserves with a view to securing monetary stability. So monetary stability was objective, which was very much there. And the second part was to generally operate the currency and credit system to the country's advantage. As early as 1934, when the Act was passed, the people who framed the Act were quite had a foresight. They actually sort of said that it is not possible to determine what is a suitable monetary system on a permanent basis, and these are being done as a temporary provisions. And once the international monetary position becomes sufficiently stable and clear, those days exchange rate pressures were very high, and that is the time then this could be rewritten. But it was as late as 2016 when the Act was fundamentally reformed, and its objective was changed to give primacy to the inflation control as an objective. So inflation control now overrides all other central banking objective, because RBI is a multi-service central bank with multiple objectives. But today, after 2016 amendment, it is very focused on targeting the inflation, and a new monetary policy framework was set up for that purpose. When one looks back at the history, of the central banking, the objective functions, operating practices have been changing from time to time. And this, in 354 years of that history, there has been not just the banking and the financial practices have changed, but political aspirations have changed. They have transformed, and economic understanding of what monetary policy can do has also deepened in some way. Today, it is very clear that monetary policy cannot affect output in the long run, but in the short run, it can do counter-cyclical stabilization. So its primary effect is on achieving price stability. And I will draw your attention to the seminal piece of Kenneth Rogoff in Quarterly Journal of Economics in 1985, which actually sort of set the clear goals for central banking in terms of the inflation mandate, because the essence of that theoretical paper was that society is better off with a central banker who gives large but finite weight to inflation in relation to, say, objectives of employment or output stabilization. So it provided a justification why central banks today are focused on inflation. And it was in 1989 that the Reserve Bank of New Zealand changed its act to become the first inflation targeting central bank from the next year. And the Bank of England did it in 1992, setting a 2.5% inflation target, which was later revised down in 2003 to 2%. And 2% now has become a standard advanced economy inflation target. It is higher for emerging market, obviously, because the nature of inflation is very different. But the central bank paradigms have changed in many ways. And the weight they have accorded to financial stability, for instance, has also changed from time to time. With the inflation targeting, it was probably relegated, but the global financial crisis caused them to rethink and bring it back along with the inflation targeting as an important goal. So operating procedures have also changed from time to time. Yeah.
So very beautifully you covered the evolution, and I wanted to ask you as a next question the changes in the perspective of working of central bank, but you covered the major aspects of the changes which have been done. Two things which I take from your response: one is the intrinsic value, and second is the intervention. While I'll come to the intervention on the next question, intrinsic value of the currency, from we have traveled from Cowrie to now we are talking about CBDC and cryptocurrencies. So what are your views on this intrinsic value being changing of the currency?
So intrinsic value of the currency changes essentially if the price level keeps changing. The rate of inflation, if it becomes high, the currency can become worthless. And while there are other modes of currency, there have been sort of competing challenges from cryptocurrencies and CBDCs. I think it's important to understand that a currency cannot really last or exist unless it has a fiduciary backing. So it is the fiduciary faith, the faith that the government will actually honor those commitments, or monetary authority will honor that commitments, that drives faith in a currency. The cryptocurrencies, so-called, are good innovations in terms of the technology, but the problem is that these technologies are not being used very productively. I mean, if blockchain has many positive effects it can have on various things, but the cryptocurrencies have no underlyings. So basically, they are as good as bubbles. I would say they are like tulip mania bubbles. The so-called stable coins, which people say will bring sort of value to the currency by keeping some underlying of government securities or reserves. Again, I think it is a misnomer, because most of the stable coins have very, very low reserves. You can't really expand that on that basis. I mean, if with $560 billion of Forex reserves, we can't ensure the value of rupee remains stable, then how do we expect stable coins to keep them stable? So, and people invest in stable coins because they think they will get some profit. So profits will come if the value changes dramatically. And so there is this misnomer that the stable coin can, if it is stable, will have no demand. And if it is not stable, then obviously it has a bubble. So central bank digital currencies are actually a competing response in some sense, but I don't think they are, the way they are being developed, it can pose a major challenge to the cryptocurrencies. I think this is an area where central banks have to probably regulate, but they don't have a legislative mandate to do this. And till that is an issue which is settled, I think it would be difficult. There is no global consensus today to ban cryptocurrencies, but from customer safety point of view, that is what should be done, because I think consumer protection is an important issue. Yeah.
Very, very rightly covered, sir. You spoke about legislative mandate. So, sir, coming to that, what are the operating frameworks of central banks and how do the intervention suggestions with the central government works?
Mhm. So, operating frameworks you mentioned. So, I think it's important to little bit understand. Like, one is the monetary policy operating framework, and one is the monetary policy framework. The monetary policy
Hmm.
framework is bigger. The monetary policy operating framework is a subset of it.
Hmm.
So, monetary policy framework is all about the entire gamut of things which
Hmm.
settles the monetary policy in some way.
Hmm.
Now, the monetary policy, the way it operates is that you have a final target, a final objective, which is invariably sort of price stability and growth.
Hmm.
Price stability getting higher in the packing order, that is
Hmm.
more important.
Hmm.
But how do you achieve that? So the central banks need an operating target.
Hmm.
Operating target of monetary policy is an economic or a financial variable which
Hmm.
the central banks wants to control and indeed can control to a very large extent on a day-to-day basis, through which like it can use its monetary policy instruments to control the operating target, and through the operating target you have to transmit the monetary policy to the larger goals.
Hmm.
So I mean uh, whereas see what is typically done in operating targets. There was
Hmm.
a time when actually sometimes the credit aggregates were used as intermediate targets. There was credit budgeting of the banks.
Hmm.
Then there was certain amount of reforms,
Hmm.
and monetary targeting became the monetary policy framework, in
Hmm.
which narrow or the broad money aggregate was the intermediate target chosen by the central bank. So they actually, it used to work in those days in that manner because we didn't have financial markets of a significant size. So
Hmm.
the only way you needed to control it was to control the quantum of money in the economy,
Hmm.
and that is something which is a sort of important thing to do.
Hmm.
And today, it is not the monetary aggregate which is the intermediate target,
Hmm.
but generally those who have done financial market reforms, have good functioning money markets, they sort of actually adopt uh, short-term interest rate as the operating target.
Hmm.
So the monetary policy actually sets the short-term interest rate.
Hmm.
It is generally the overnight uncollateralized money market rate between the banks.
Hmm.
So the call money rate in India, for instance.
Hmm.
But several countries, some of the countries, I won't say many, many, also have, say, a 7-day repurchase agreement repo
Hmm.
or the 14-day repo rates as
Hmm.
the intermediate targets.
Hmm.
So they actually change the operating targets through the policy variables in
Hmm.
order to influence the final goals. So
Hmm.
this is how the monetary policy works.
Hmm. Hmm. Sir, you spoke about two aspects. I have to draw your attention to a third aspect also of financial market committee. So you have seen both the aspects of central bank functioning monetary policy committee, which takes decision on my EMIs, and also the financial market committee, which handles the financial markets. How different are these two functions, and based on your experience?
So, Sachin, they are different, though they are related, they are very different.
Hmm.
The job of the Monetary Policy Committee is to formulate the monetary policy. So, it would set the the policy rate and typically the policy rate is in terms of the repo rate, the overnight repo rate, and the market rate of call money actually gets anchored to that repo rate. So there are various ways in which this is done. One of the most plausible way and most effective way is that the central bank does its financial market operations, which is the job of the financial market committee, in a manner that they inject the liquidity or they absorb the liquidity if it is surplus on that policy rate. So they set an interest rate corridor, the interest corridor could be on the floor, which could be a standing deposit facility of some sort, which will be a lower rate than the policy rate. And they would inject liquidity through a standing facility. See, on a policy rate, you don't do operations all the time. It's depending upon whether you have an assessment of how much liquidity is needed to clear the markets. That is what you would do on a policy rate. But there is a standing facility at the top of the interest rate corridor at which you are injecting the liquidity. The idea of having a corridor is that you are allowing interest rate movements within the corridor in the money market. Because a bank standing facility in terms means which can be initiated on the initiative of the bank. It's not for the central bank to decide its operations, but it has a window of the standing facility to inject liquidity as well as to absorb liquidity. So a bank will not like to pay more than the standing lending facility rate in order to sort of have that extra liquidity, and they won't like to get less than the standing deposit rate in order to park the surplus funds. So this is the way interest rates in the money market are stabilized around the policy rate. The policy rate is set by the Monetary Policy Committee, which it thinks is the best rate in order to deliver the final goal of the inflation. So the job of the Financial Market Committee is to do financial market operations so that the market rates converge to that policy rates. And this is how then the transmission begins from the short-term interest rate to maybe the CPCDs, or which are also a little longish money market instruments, or on the debt market side, on the sovereign yield curve, the T-bill rates, the more dated securities, maybe in 2 to 5 year segment, and then maybe 2 to 10 year segment, and the long end of it, 30-year segment. The yields move according to the signals which the central bank gives by setting the policy rates, and those in turn affect. Those are the benchmark rates. Say affect the pricing of other financial products. Your credit costs get affected, and from those you are actually by changing the pace of the credit, you are trying to influence what will be your inflation and the growth, which are the final objectives.
Very beautifully explained, sir. You spoke about short-term and long-term and inflation targeting. So I just want to understand how this targeting happens. It is done on some long-term plans or some short-term sentiments in the nation.
Okay. So, these are not very long-term plans, but these are neither very short-term in the nature of sentiments. So, actually, one has to recognize that monetary policy operates with a lag. So, if you are changing the policy rate today, it's not that instantaneously it will transmit across to the entire curve and then affect the final goals. The final goals may get affected maybe 2 to 3 quarters down the line. So it takes time for it to move. And basically, therefore, it cannot be very short term. So you have to take into account these lags. But the problem which a monetary policymaker faces is that these longs can often be long and, more importantly, variable. So in terms of time. So it is uncertain that today you think that it is 2 to 3 quarters. Sometimes it may take longer, sometimes it may be faster transmission. So it often becomes, the policy decision becomes that much more difficult uh, in that sense.
Obviously, sir, it's really a difficult task to be done. But at the same time, does the central bank also have a role to play to ensure that as a country we have net exports which are positive?
So a country, whether it runs net export which are positive or not, is not necessarily the objective of any central bank. Whether you run trade balance or the which is trade surplus or trade deficit, or a current account surplus or a current account deficit, actually also depends on your stage of growth and your requirements. So if you are a developing country, you need sort of foreign savings to come in and boost your growth rate. It would be foolhardy to try and run a current account surplus. So what the central bank needs to be worried about is that your current account should be sustainable. And when I say sustainable, what it means is that if you are running current account deficit, then it should be financeable over a medium term. So it should not be that you end up running a current account deficit, but you don't have financing from abroad, and then you have a financial crash coming in. So you have to balance things and take a call. And in any case, these are variables which are not exogenously set by the central bank. They get determined by the demands which exist and what the private sector exists. But central bank can use its instruments to see that your kind of these gaps, especially the twin deficits, which often create a problem, which means current account and the fiscal deficit. Fiscal deficit obviously is not in the central bank control, but they can cause a huge problem in terms of maintaining financial stability. So the task is to sort of modulate them accordingly. But also, say, a high inflation can cause currency to weaken very sharply. So that's also a concern which exists.
So coming to, you spoke about the Forex exchange rates and all. So how important is the role of Forex reserves? Because we have seen situation in the past of 2 times rupee being devalued and then crisis of 1991. So how important is the role of Forex reserves in such a situation?
So I would say that the first line of defense against instability is that you should maintain macro financial stability. There is nothing better than that. But the second important thing to do as a tool is to build adequate buffers in the form of foreign exchange reserves, because capital flows are notorious, in today's world. Especially the emerging markets face this problem that you have sudden stops of capital flows or sudden surges of capital flows, then sudden stops, and even sudden reversals of a massive order of flows. To recall, like when the global financial crisis struck, we lost almost $80 billion. When pandemic struck us, actually in 2020, from if you see the when I say 80 billion, these are like emerging markets I'm talking.
mm, mm,
So emerging markets lost 100 billion, over 100 billion US dollars of flows within a matter of months from January in the first half of 21. At one stage, the outflows were more than 100 billion US dollars. And that's a massive sum. So it causes a lot of instability, and on such occasion, if you don't have buffers, then you face enormous difficulty. We face that in taper tantrum period, for instance.
mm, mm,
In some sense, it was thought that we should intervene less in the foreign exchange market. So we did not build enough buffers, trying to increase our flexibility of the exchange rate to let it get market determined. But when the taper tantrum crisis struck us, we felt that our reserves are at least 50 billion short, and there
mm,
were speculative forces which were trying to attack and hit us. So it was a tough period. We could manage, that's a different
mm,
thing.
mm,
But it's always good to have sufficient buffer, but you also have to be mindful that reserves are not costless. So reserves carry a cost. You obviously earn something on returns on the reserves, but the massive cost of sterilization of those
mm,
reserves
mm,
is a huge cost for the economy, because if you don't, what you build in foreign exchange reserves,
mm,
so you are buying, say, dollars, that much rupee you are releasing domestic markets, and
mm,
therefore you can't control the liquidity or the money supply in the market. So
mm,
you need to sterilize that amount and get your monetary targets back, and
mm,
those are costly operations and
mm.
cost some.
Sir, you worked on the regulations part also. So, what financial working on different regulations for the financial sector? What are the key factors which are considered for creating any such regulation?
So there are two things. See, one, obviously, you need to do some kind of micro regulations and micro supervisions of the sort. But I think central bank job is also more focused on uh, macro calls on the regulations, and so you have to see what are your macro prudential tools. So in that sense, you need to see you are not sort of building a credit bubble of a sort. Banks are, say, indiscriminately lending, then you can use various kind of regulatory measures, such as say, loan to value ratio or
Mm,
risk weights, which are placed. You can use a set of soft capital count measures if need be, but ideally you should use macroprudential measures in good times. You can build
mm,
counter-cyclical buffer, for instance.
mm, mm,
So these are very important tools for regulation,
mm,
and the regulation has to be focused that the systemic stability is maintained in
mm,
the financial system.
mm,
So while an odd bank can always fail, but there should be no systemic repercussions of loss of confidence or in the entire system with which
mm,
market works. Because I mean, even with one bank failure, if it is systemically important, it
mm.
can cause a run on other banks and generate a problem of
Yes.
stability.
Mm. So during COVID, we have seen the cost push inflation as well as we have seen supply shock inflation. What was moving around an ED of an RBI during such a situation in the economy?
So, Sachin, two things here. I mean, obviously, the main thing is that this was an extraordinary shock. So
Mm,
this shock doesn't happen even once in a decade. It's like
mm,
once in a century shock.
mm, mm,
So, and it came with a double whammy that both demand and supply got affected immediately.
Hmm.
That was a massive supply side shock from one side and demand side shock from another. From the demand side, obviously, the demand had collapsed, so you could afford monetary easing to sort of arrest that. And there was also this issue that you had to limit the scarring which
Hmm.
the pandemic can cause, because there could be business failures, there could be household debt collapses, people are going jobless. So a lot of economic capital might get lost. And this was having an overwhelming bearing on our minds,
Hmm.
because uh, in such a situation, one can't be an inflation nutter, even if you were sort of doing inflation targeting. See, ultimately, we had a flexible inflation targeting framework, and therefore, what the central bank did, and did it pretty well very early on,
Hmm.
was to impart liquidity, because spreads were winding. Financial spreads in March 2020 were at amazing highs, and
Hmm.
it looked like everything would collapse.
Hmm.
So the central banks moved very energetically to stabilize by imparting liquidity and cutting policy rates.
Hmm.
And this happened across geographies. So, and central banks were the first to come to the rescue. Fiscal authorities took a while, and
Hmm.
that was naturally because of the nature of the two policies. So, I think central banks achieved the objective of stabilizing sentiments, and you mentioned sentiments earlier. So
Hmm.
I'm saying that for central banks, it's very important to view sentiments in a manner that it shouldn't affect inflation expectations, which can then feed on inflation itself. Because if inflation expectations go high, then the economic agents build that into contracts, be it they may demand higher wages. If you see what happened on house rent contracts in India, you know, before the inflation targeting framework, when we were running near double digit CPI inflation,
Hmm.
uh, we didn't have a national matrix, but whatever, I mean, the six CPIs we were looking at, actually, all were sort of running close to double digits for almost 6 years.
Hmm.
So you had lost the nominal anchor, the inflation expectations had become unhinged,
Hmm.
and you could see that in, say, for housing rent contracts. If you were going and sort of registering your rent contract, you
Hmm.
would do an escalation clause, annual escalation clause in
Hmm.
double digits. So in those
Hmm.
days, everyone was demanding 10% or more as an annual escalation clause. So
Hmm.
these are typically unhinged inflation expectations, and that are very bad because they feed in a spiral on the inflation. So uh, uh, coming back to sort of what central banks were doing, they stabilized those expectations. They didn't feel that inflation expectations can become unhinged in the
Hmm.
circumstances we were in,
Hmm.
uh, probably underestimating the length of supply shock.
Hmm.
So the supply shock actually lasted too long in the pandemic, and
Hmm.
was reinforced by other shocks like the Ukraine war and stuff,
Hmm.
which actually has now put the central banks in a situation where inflation expectations can become unhinged, and there would be second round effects on the inflation.
Hmm.
So it's true that the central banks didn't tighten policies in time, monetary policy in time, because this fear of a huge shock in growth was affecting their considerations. And now, when the inflation sprung very quickly and very sharply, I mean, if you see the advanced economies, they are running inflation at 4 times their targets.
Hmm.
We are much better off. I mean, we are true on the upper edge of the inflation targeting band or a little above that, but it's not like complete loss of control that we see in many advanced economies where inflation is running 4 times the target and the central banks are being forced to backtrack and try to get back on the curve, having been caught behind the curve. So that is how things have shaped.
Sir, you have covered it very nicely that the other countries, how comparison can be done in terms of inflation. But for me as a common man, if I talk about home loan, 6.7% to 8.1% in 3 months. And do you think that there is a better alternative than raising interest rates to lower inflation?
I don't think there's a better alternative. I think we should accept that we will have to face a small sacrifice if we want to get control of this inflation back. To say that the interest rate should be lowered, let me very frankly tell you that we actually ran negative real interest rates for pretty long, and that is not something good for the economy. Because it is causing financial repression and savers lose money in true sense. There is no incentive to save when you have negative real rates. So think of a pensioner who has no other income and is keeping deposits in the bank, and he earns something at best, even if it does a weighted average cost of those deposits could be a little over 4%, while you are running inflation at 6-7%, then you are really sort of disincentivizing saving. This could be a cause where saving investment gap can widen, and saving investment gap, if many of you may not know, is just a mirror of the current account. So your current account would widen and become unsustainable. So I think central banks are doing absolutely right in raising the interest rates, and this is a cost we have to bear now to bring back stability, even at the cost of growth slowdown.
Very beautifully, you have shown us the other side of the coin, sir. Now, bringing in some angle from the political side of it, sir, we know that inflation only creates, through a study, 0.6% impact on the voting decision, whereas the growth impacts 1.6%. How the central bank manages this situation, particularly during the election years?
So, Sachin, I'm not really sure. From where these statistics are coming, is it based on some formal study? If it is based on some formal study, does it have a robust methodology? To my mind, the relative effect of growth and inflation differs across countries and differs across time. So, public generally have a short memory. So often they may sort of tend to give growth more importance than inflation, because growth is related to jobs, and therefore they may give more political importance till the time control on inflation goes. The moment control on inflation goes, the public can really punish the political authorities for doing that. And if you think that focusing on growth gives votes and focusing on inflation costs votes, it could just be the reverse when inflation is high. You think of what the countries which faced hyperinflation. Germany's Weimar, if you think, the inflation rate had actually touched 29,500% in October of 1923. So, which is like every day the prices are rising by 21%, and approximately in 3.7 days the prices are getting double. Now, think of such an environment, what public will do. So we have also seen similarly Hungarian National Bank facing sort of similar problems, and that that is, there actually there was a time in 1946 when the currency in circulation actually ran over 100 quintillion pangos. Now that means 10 raised to the power 36 is an astronomical sum. Zimbabwe, the annual inflation rate had touched 89.76 trillion, which is 10 raised to the power 36. So how would people tolerate such inflation? I mean, today I was reading somewhere that what at the price at which you were able to buy a Volkswagen car in Turkey, you are actually spending now the same price in a matter of years. I'm saying you are buying a mobile in the same price. So I think when inflation goes out of control, and we have seen that in India. I mean, there are governments which have lost elections because of inflation, because of onion prices, for instance. Just the onion prices rising have costed people the government's job. So let's not underestimate that, okay, the public gives greater weight to growth than to inflation.
Thank you very much for this wonderful insight, sir. We had a great time talking to you, and the audiences of Indian Sun would love to listen to this interaction. I know your schedule is very tight, and you took out time for us. That's very great of you. Thank you very much, sir.
Thank you, Sachin. It was nice talking to you. Best wishes. Bye.
Audiences, that was Dr. Mridul Saggar, former executive director from RBI, for you, simplifying the concepts of macroeconomics and giving you the traits from the inside of the central bank. We will soon bring new stuff for you. Enjoy this session. Thank you very much.